Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today I want to answer a question from the audience because last week I saw a question that I thought was really interesting, and I'm just going to summarize the question and then give you my answer and explain why my answer is what it is. Okay, so the question was essentially, should I take out a personal loan, pay 5% interest, and take that money and invest in a stock or an ETF or something of that nature? Is this a good idea? Yes or no? My answer is no, and I'm going to explain why, but essentially the risk is not worth the reward in my view. Okay, so if you're taking out, whether it's a $50,000 loan, even a $10,000 loan, the math just usually does not end up in your favor, especially if the interest rate is 5%. Here's why. Here in the US, the average return when you include inflation for the stock market, depending on who you ask, but it's really like 10 to 7%. Let's go with 7% just to be conservative, because you get 10% on an average year, 2 to 3% inflation, that's going to get you 7%. So if I am going to make 7% on average, that's not every year. Clearly, last year we saw the stock market fall, but I bring in 7%, but I have to pay 5% interest. That only leaves me with a 2% cushion, right? I'm only making 2% on that, which if I'm only going to make 2%, I could put that in a savings account today, right? There are plenty of savings accounts, whereas Ally or Marcus, I mean, left and right, most online banks are paying 2% or more on a savings account. So that I could do that and take almost zero risk, because here, those are FDIC insured. So if the bank crashes, I'm still getting my money back. And I don't have to worry about any type of fluctuations or market crashes or anything like that. So if I'm gonna make 2%, that's where I'm gonna go, right? So that's one part of it. The other side is, what happens if you guess wrong? Obviously, if you take out any sum of money and you're borrowing and you have to pay interest rate, it's great if I invest in something like Oxy Petroleum in 2022, right? Imagine taking out $50,000 and then the stock goes up 110%. That was Oxy Petroleum. That's great. That's perfect. It's risky, but it would have paid off. What if you're somebody like me, okay? We produce these videos, 250 videos a year. I've gone to school for this. I've been a financial advisor. I do this all the time. I've been doing this for close to 13 years. And what did I say this time last year? I said that banks were good. They should have been good. We talked about Ally, we talked about Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America. All of those should have done well because interest rates were going up. What did we not expect? We did not expect the Russian-Ukraine situation. We did not expect the fears of recession. Therefore, I think JP Morgan lost like 11 or 12%. Guess what? Right? Imagine you take out $50,000 and you think that banks are going to do well, and then that $50,000 is 45, or the $50,000 is now 40,000 or even 35,000. So now you own stock that is worth less, but you still have to pay back $50,000. That is a significant loss that I don't think adds up. Adds up if you got Oxy Petroleum, does not add up if you had any of the banks for the majority of last year. Right? Imagine if you invested in Lyft. Remember, just on Friday, we had talked about Lyft. Uber is doing fine, but Lyft is not. And we found out that Lyft lost 35% in a day. Imagine that, where, again, you're taking out a loan on Thursday, the very next day, earnings is announced, and earnings happen all throughout the year, and you lose 35% in a day. It happened to Netflix, not all of last year, the first half of last year, where they announced earnings for Q4 of the previous year and then Q1, and it lost 25% every time they announced earnings, or the first two times, rather, that they announced earnings. That's a lot of loss, right? That you have to guarantee to pay back the bank or, whatever institution that you borrow the money from. For me, again, risk versus reward does not add up in this case, especially in a regular normal case. If I'm just saying on an average year, 7% minus the percent that I'm paying back to the bank, I can get 2% for near zero risk. Not no risk, but near zero risk. The other thing that you want to pay attention to, and that I've seen people do this as someone who has been a financial advisor, I have had 2 clients in my entire career that have used loans and have done okay. The difference though, and I don't know everybody's situation who's watching this, however, the difference is I think they had like a $65,000 to $75,000 loan they had borrowed and then invested in the market, and they were fine at the time. The thing was, they had hundreds of thousands of dollars in their checking account. So if the loan went bad and the stock wasn't worth what they thought it was going to be worth, they could pay off the loan very, very easily. Unless you got that type of money laying around, then that's something that you might want to consider in case things don't go well. So if you're taking out a $50,000 loan, if you got $50,000 in cash, I'm not talking about pulling from retirement accounts and you got to sell this and do that. I'm talking about just sitting around not doing nothing. Then maybe it makes more sense, but I still wouldn't do it if that were the case. I would just use the money I have so that I don't have to pay anybody back should things not go the way that I expect. But there are cases where it could make sense, and it's usually for people who have the money to cover the loan, sometimes 2.5 times over. So that is something that you absolutely want to pay attention to. For most average people, most regular people, that answer is no. And I think that the reasons as to why I think I may have made blatantly obvious is just extremely hard to choose the right stock every single time. And when you take out a loan, you take away the ability to be wrong, right? And that's the thing. I've said this multiple times in these videos where I want to make sure that I'm choosing my investments in a way that obviously I want to be right more often than not, but I do so in a way that if I'm wrong, I can afford to be wrong. This is why I follow the 5% rule, where I don't put any out of all the money that I have, I don't put all more than 5% in any one stock, because if I invest in a bank and I put all my money in a bank of last year, that wouldn't have been great. Thankfully, right, I split my money up between tech, which didn't do well. A little bit of it was in banks that didn't do well, but I had O'Reilly's, right? I had a bunch of dividend stocks that did fine, right? We talked a lot about GPC the second half of the year, right? So I had Progressive, right? I had T-Mobile. Like, those were the things that really kept my portfolio together, because I was able to be wrong, because I had 2 or 3 that didn't do well, but I had 5 or 6 that did. So I was able to balance things out and do okay in a year where the stock market was down like 20%. And again, if you were just investing in an average ETF, you were lost 20% last year and had to pay 15% on interest on a loan that's worth less. So you're talking borrowing $50,000, losing, and now you're at 40, and you still have to pay 5% on top of that. So for me, the answer is no. And there are very, very small circumstances in which it can make sense. Makes sense if it's buying real estate, right? You can rent that property, right? It still holds some value to you. Even if the stocks pay dividends, it's going to be hard to really make up that difference. It might make sense to start certain types of businesses, but again, anytime you're taking on a loan, you take the ability to be wrong, and those margins really shrink where you have to be perfect, because if you're not, that bill will come due. All right, that is it for me. I will talk to y'all tomorrow. Make sure that you check out the members only. We just dropped another exclusive video on Friday, like we do every week. You want to make sure that you're in there. We do deep dive breakdowns about the stock market, about questions that you guys ask, exclusive lists as well, and things that you definitely want to be paying attention to. All right, that's it for me. Talk to you tomorrow.